reflections and how to proceed and what kind of policy path that this country should embark on.
All right, let's leave it there. Neela Richardson, Edward Jones, investment strategist. Let's hope we see you in the studio next time.
I would like that. Good to be with you audibly, though.
All right, we'll talk to you soon.
Take care.
Do stick around. Much more ahead on the markets on the first trade. And we'll speak to the New York Stock Exchange President Stacey Cunningham about their big reopening of the trading floor today. Stay tuned.
For the first time in more than 2 months, traders are back on the floor of the New York Stock Exchange, but this time there are all sorts of protections in place to keep them safe. Joining us now is the president of the New York Stock Exchange, Stacey Cunningham, from the floor. Good morning, Stacey, and thanks for making time for us today. So back to business there at the exchange, but far from being back to business as normal. Give us an idea of some of the changes there on the floor of the exchange.
So there are a number of precautionary safety measures that we put in place. One, masks. So just like I'm wearing a mask, every single person on the trading floor is required to wear a mask. We're enforcing social distancing. We have a medical screening and temperature check as people come into the building. There are just a number of layers of protection that we've implemented so that we can not prevent a single case, but prevent an outbreak on the trading floor.
Stacey, Brian here. The country is going through continues to go through a tough time here. What is reopening the trading floor? What is that? What message does that send America?
It's time for us to start to reopen our economy, to start to reopen America, but to do it cautiously and to do it with everything we've learned about this virus and how to protect ourselves. And we protect ourselves by protecting others around us. So while we are reopening, this is not back to business as usual. I'm wearing a mask. That's really important. As I saw some of the video footage over the weekend of people in locations that are reopening, they need to make sure that they're still using the protective measures that we've learned that are so important and so critical during this time. Otherwise, the whole fact that we've been shut down for 2 months will be a waste if we don't continue to be cautious and continue to protect ourselves. So the reopening means it's time to get the economy restarted, but to do it smartly and slowly and cautiously.
Stacey, you have fewer traders on the floor as well. Some of these brokers are smaller companies. I think people always think, it's the big firms that are there on the floor. Sure, you have that, but you have some smaller brokerages as well. This is their bread and butter. How many floor traders do you have back right now? And what are you hearing, especially from some of those smaller brokers, about what reopening means to them and to their businesses?
Yeah, you're absolutely right, Alexa. So this trading floor is made up of a number of different types of firms. And as you know, most of them don't work for the New York Stock Exchange. But the firms on the trading floor might be very large firms with global footprints and also some smaller businesses. So we have about 10 to 15% of the overall business population is back today, 25% of the trading floor. So we skewed that to the floor, and then we skewed that 25% to the small businesses that have been most impacted by this shutdown. So that's the initial group that we're back with. They're super excited to be back. They're really excited to be getting back to work, and there are lots of smiles and thank yous and virtual high fives this morning.
Stacey, how do you imagine the IPO process will look different? We all know going public is a big event, lots of crowds. How have you thought about redoing that process?
Yeah, so importantly, that's been ongoing, right? We've had a number of IPOs throughout the period of time, even since we shut down. We've raised over $30 billion of capital on the NYSE when the floor was closed. We've had a couple of companies IPO throughout this process. Certainly the celebrations look a little bit different than they did at that time, but there's the time and place to get back to a on-floor celebration, and we can also celebrate virtually in the meantime. We actually have seen a pickup in the IPO market recently.
You have. That's encouraging as well. What about your market makers? Are they among the people who are back on the floor right now, or are they still working virtually?
No, those firms we've asked to stay virtual at this point in time. They're larger trading firms, and they can do most of what they are trading each day. They can accomplish most of that remotely. So while we do lose some value of their not having that human judgment here, we've asked them to take a back seat on the first phase of reopening so we could focus on the small to mid-sized businesses.
What does the next phase of reopening look like, and what is the timeline for that, Stacey?
Yeah, the timeline is TBD because that's going to be based on conditions and how we continue to have success through phase one and in New York City more broadly. But we do want to bring those market makers back in. Importantly, while those market makers are remotely, they still have the same obligations that they have with respect to trading the stocks that they're assigned to them. So they're meeting those obligations remotely, but we want to bring back that element of human judgment. So they'll be part of a phase two.
Historically, when we look back, I mean, I even think when I was reporting from the stock exchange, those sort of milestone moments when the exchange had to close and then reopen, where does this fit sort of in the history of the exchange in terms of longest shutdowns? I mean, I'm thinking back to 9/11. I believe that shutdown was just 4 days. I think things had a shutdown during Superstorm Sandy. Where does this more than 2-month shutdown sort of fit into the history of the exchange?
Well, I would call this a zero shutdown because trading went through the entire time. So this was unlike any of those events you mentioned before. It was the first time ever where we closed the trading floor but continued trading. So this is very different than those prior examples. But during the war several decades ago, we were shut down. The exchange itself, trading included, was shut down for 4 months. So the floor has been closed for long periods of time throughout history, over our 228-year history. But this is the first time that trading continued and the trading floor was not open.
Well, we are happy to see you back there, and a small sense of normalcy, if you will, starting to return. You got a nice rally to kick things off this morning as well. Stacey Cunningham, president of the New York Stock Exchange. Thanks so much.
Thank you. Certainly a milestone morning. It was fun to have Governor Cuomo here with us this morning.
It certainly was, mask and all. All right, thanks, Stacey. And stay with us. We have got more on, we're going to take a closer look at the bond market and how the Federal Reserve's actions are impacting things there right after this.
Welcome back to the first trade. We're also keeping a close eye on the bond markets this morning. Treasury yields have been stuck near all-time lows ahead of the Fed's new Main Street lending program that is supposed to be ready to roll finally by the end of this week. Let's talk about all this with Guy Benstead, portfolio manager at Shelton Capital Management. Good to speak with you again. The yields really have been near record lows again. What is the Treasury market telling you about what the Federal Reserve may or may not do at its next couple meetings?
Well, I think the Treasury market is displaying some of the same signals of confidence that we're seeing in equities and in credit. So we're seeing front-end rates anchored to record lows. We've seen limited volatility, but a little increased volatility in the 10-year sector. And we're seeing the curve steepening. All those things are positive signals economically, consistent with the thought that maybe the markets are a little bit ahead of the real economy. But what we're seeing in the other credit markets of risk, of corporate bonds and the like, is some significant confidence showing up there.
Guy, what about investors who want to have a little more exposure to the bond market? Is it a good time to buy treasuries? Should they maybe be looking at corporate debt right now?
Well, I'm biased. I think corporate debt is significantly better valued than treasuries. I think treasuries as a risk protection asset are okay. I don't think there's a tremendous risk of higher rates, particularly in the front end of the curve. The Fed may even begin to fix rates out to 3 to 5 years, but you're going to see some volatility in the long end. I think that a better place for extra money is either high quality corporates or high quality municipal bonds. The tax exempt yields there are attractive. And for more adventurous investors, we like certain high yield credits, hiring managers who can do their homework and sort through. There's been a lot. There's going to be increased defaults. There's going to be increased restructurings. But I think there are a number of companies that have bolstered their liquidity to a point where they're going to make it through the economic dip that we're inevitably going to see in the second, probably the third quarter, and come out of it fine on the other side.
Guy, you're scaring me a little bit with the bull call on munis and high yield debt. Why that confidence? Is it a just a broad-based stroke here, where you're saying that if the Fed is backed up these markets, so these companies and states are okay?
Well, the Fed has backed up the markets, that's for sure. They've come out with a bit of an alphabet soup of programs to support both the primary and secondary credit markets. They're being very judicious with that credit, however. They're bleeding it into the market slowly. A lot of the programs that they've announced, they haven't even begun to implement yet the market's taking a lot of comfort from those. It's important to not paint the market, especially the credit markets, with one broad brush, and the muni market's a great example. There's not just one muni market. It is 50 states, it's countless counties, it's countless agencies. And so there are definitely going to be strains and stress, and some of those are going to be headline worthy. But the bulk of quality borrowers in both municipal and corporates are going to be okay. And if you just go back a few months ago, way back in January and February, risk premiums were at historic heights. Now, we're not still at the wides, but March certainly provided a blowout of spreads, and we're still finding things that we think are pretty relative on a relative value basis attractive.
Guy, if we see, I guess a few different scenarios could play out here as more states begin to reopen. If we see a moderate recovery, what do you think risk appetite is going to be on the part of investors? Are we still going to see healthy spots relative to equities in the bond market? I'm talking investment grade debt, maybe even emerging market bonds. What do you think the fate of those assets will be if we experience a moderate economic recovery?
I think it's going to be a tale of haves and have-nots. There are a lot of companies that right now are grabbing headlines, bankruptcies left and right, whether it's in retail. You had your Hertz Rent-A-Car over the weekend. And those are companies that were stressed even before the pandemic. And I think a lot of those companies are going to have to be restructured. They may live on, but they're going to be stressed. Again, in the credit markets, it's all about where the bond's priced. It's all about relative value, and so if you can buy companies that are money good at discount prices, then that's a good investment opportunity. The way we see it, I think that it's important to not be too risk averse. And again, I think an economic recovery is going to occur. It's a matter of when and how long. And what we don't know is, as the economy gradually opens up, where are consumer preferences? Where's the appetite going to be? Are people still going to go out? Are people going to fly? I'll tell you, I flew last week, and it was a ghost town in each airport and on the airplanes. And I think airlines are going to struggle. I think there are significant changes in business models that are going to have to take place, and there's a lot of uncertainty to how that's going to play out.
All right, let's leave it there. Guy Benstead, Portfolio Manager at Shelton Capital Management. Thanks for taking some time this morning.
Thanks, Brian. Thanks, Alexis.
And some breaking news worth mentioning very quickly. Two positive reads on the economy. U.S. consumer confidence nudged up in May. That's not too bad. And sales of U.S. single-family homes unexpectedly rose in April, up 0.6%, both underpinning perhaps this market rally. But a quick programming note for you. Tomorrow, May 27th, Yahoo Finance at 5 p.m., Yahoo Finance will be airing a special called #ResetYourMindset. We will bring together industry thought leaders, newsmakers, athletes, celebrities, and medical experts for an open conversation on topics of wellness, mental, emotional, and physical, and how it translates at home into the future of work. Much more ahead on The First Trade. Welcome back to
the first trade. All right, let's get another check of the markets here with Inez Ferre. Inez, what do you have your eye on? I think we were looking at some airlines this morning, right? How are they doing?
Alexis, airlines are soaring this morning. Also, I want to mention European airlines are also soaring on reports that Germany plans to lift its travel warning for 31 European countries. But let's take a look at some of the U.S. airlines. We're looking at Southwest up more than 10%, United up more than 11%, Delta also higher, as well as American. I do want to mention LATAM Airlines. That stock was halted earlier this morning in pre-market. LATAM announcing that it is filing for Chapter 11 bankruptcy protection. The main driver, of course, being COVID-19. Remember that Latin America is now the epicenter of the pandemic, and it is worth noting that Delta last year invested $1.9 billion for a 20% stake in LATAM. And then if we also take a look this morning at some of the cruise liners, those are all higher. We're looking at Carnival up more than 12%.
What's up,
Norwegian
KK?
also higher. Carnival,
KK,
by
what's
the
up,
way,
man?
recently announced that it
Trying
plans
to do
to
the
resume
giveaway. Let's
some
just
operations
log
from
into
3
Twitch.
U.S. ports starting in August if the country will permit it.
It's
if
on
the
my
CDC
Twitch
will permit
page,
it.
buddy.
So we're
If
looking
you
at
go to
these
my
travel
Twitch,
stocks that today are really
you
soaring.
can type that
It
command
means
in,
that
and you
state
can enter the
economies are
giveaway.
reopening and Europe also reopening. Alexis, Brian?
All right. Thanks so much, Inez. Traders are back on the floor of the New York Stock Exchange this morning for the first time since late March. One of them, Jonathan Corpina of Meridian Equity Partners, joins us now. Jonathan, always good to speak with you. So what is it like? Take us through the process of getting into work this morning.
Good morning, Brian. Yeah, it was quite different, right? Normally I take the train coming into work, into Grand Central, and take the subway downtown. So drove in today, which was much quicker than it normally would be on a day where there's a lot of traffic. But coming into the building today, clearly emotions were felt. Very excited to be back in this reopening. We knew this day was going to come at some point. When the date was announced last week, started working on the reopening process here with the exchange as far as layouts.
You have Twitch?
Technology is concerned, so happy to be here. Screening, walking.
You can follow my Twitch page, Twitch TV.
And then once on the floor, have to
I'll
wear
post it
a
in the
mask
chat for you, though,
required
buddy.
at all times when inside the building here. Hand sanitizers have been placed throughout the floor.
Twitch TV,
Social
Skeeter Season
distancing,
TV.
Stamps and markings have been placed everywhere. We've got some areas that have plexiglass in between workstations. So clearly a very clean, controlled environment that the traders can come back and work in.
Hey, Jonathan, I'm just curious, are you, on a human level, are you just worried? Was there trepidation coming back to the floor? A lot of your friends and colleagues, or some of them, I should say, did come down with COVID-19. They have recovered or are still in recovery mode. Some of them are not back on the floor yet. Are you fearful at all about contracting this as you're making your way into work or while you're on the floor?
Right, so of the 1,000+ people that work in this building, there was a very, very small number that did come down with it. And with the processes that the NYSE has put in place prior to the close and to this point and moving forward are at very, very high levels. I feel very comfortable coming back into this building. Every 24 hours, they are sanitizing everything in this entire room behind me.
See you later. Let me check. All right, buddy. I'm streaming this on that as well. So
cleanest,
if you
safest
type it,
place
I'll be
to
able to
be in the
see.
United States right now. There are risks going anywhere. There are risks going to your local grocery store, your pharmacy, and those risks are going to continue. It's just a question of what are the best practices to mitigate those risks. The NYSE has clearly done that, and everybody in this building right now feels very comfortable to be here.
Jonathan, was it harder or easier to do your job from home?
I'm sorry, Brian, can you repeat that?
Yeah, was it harder or easier just working from home for what you do?
It's definitely harder, right? So being here in this environment and having other traders around me, we're able to communicate back and forth, face to face, to get price discovery, to be able to find larger blocks, to be able to give our clients the best price. And our clients are mutual funds, pension funds, hedge funds. That trickles right down to the end investor, the 401k, the IRA holders. So being off the floor definitely had a little bit of a disconnect. Back in this room right now, the sights, the sounds, the action that goes on around you, albeit less today with the capacity constraints, it certainly adds to being more productive and being much more efficient when trading here on the floor. In addition, there are some tools that we have here on the floor that are only on the floor and cannot be used or accessed from outside the building. So having those back in place is clearly a benefit for the end investor.
Jonathan, we spoke with the president of the exchange, Stacey Cunningham, a little earlier, and she was telling us how the specialists or so-called market makers are not on the floor right now. They're still working virtually. How does that impact what you need to do on a day-to-day basis, not having them there physically?
Yeah, so coming back to this, we knew that that was going to be part of the plan and part of the rollout, and there had to be a little give and take on all sides as far as what the phases were going to look like. Not having them here certainly is something that does not overall help our processes and what we do and how we do it. They help with the price discovery process. They help with adding liquidity into the market. They help as a catalyst, matching up buyers and sellers together. Looking forward to them coming back, and that's clearly going to be something that will help us as traders, which will help our clients and investors. But for now, they are trading virtually. They're still providing liquidity from off the floor. We're just missing that human face-to-face interaction, which will come back soon.
Jonathan, I don't have to tell you this. The trading floor community bounced back significantly after 9/11. But is there something different about this event where you may not see a lot of your friends come back to the trading floor?
It certainly is different, right? I mean, I was here for 9/11, and when we reopened a few days later, everybody was back here, those who could make it. Same thing for Sandy. We closed for a few days there, and everybody who could make it in was back in. This is certainly different, but the fact that we knew about this and was part of the plan and part of the process, coming back and choosing that of the 16 Meridian employees, only 6 will be back here on the floor. Yes, it is different, but we were aware of that, and we were able to make those adjustments coming in. And also knowing that my 6 is going to go to 8, 10, 12. At some point, I don't know when, but at some point we are going to be able to bring our additional employees back here, is a light at the end of the tunnel for us.
All right, let's leave it there. Jonathan Corpino, Meridian Equity Partners, Senior Managing Partner. Good to speak with you from the New York Stock Exchange floor again.
Brian, Alexis, have a great day. Thank you.
You too. Stick around, much more ahead on the markets on the first trade. Welcome back to the first trade. Let's take a look at one of the companies we're watching on yahoofinance.com. Warner Music Group announced its plans to go public on the NASDAQ. The initial public offering will be between $23 and $26 a share. Alexis, Warner filed an amended filing this morning with the SEC, and buried halfway down, they tell you how sales have been in April. Their streaming sales were up 12% for April alone. This company is making money. Profits are holding up well. All in all, this might be a pretty hot IPO.
Yeah, it could be. And, we just spoke with, of course, the president of the stock exchange, New York Stock Exchange, Stacey Cunningham, a little while ago. And she said the pipeline for IPOs starting to pick up. And they've actually had some IPOs during this pandemic, although it's sort of been under the radar. Of course, Warner Music would be going public on the NASDAQ, their rival exchange. But if they do go ahead with this at between $23 and $26 a share, it would value the company at $1.8 billion. Now, remember, they were supposed to go public in February. And then the world as we know it got upended, and they decided to hold off for a little bit. You're talking about streaming being strong, but what about some other areas that aren't right now? No concerts going on, video shoots having to be canceled, merchandise sales. I mean, they're able to sell those things at concerts. We're really not seeing that happen right now. So it'll be interesting to see what appetite is like for a company like Warner Music during this pandemic. Are they diversified enough to get a lot of interest from investors?
But they have Cardi B and Bruno Mars, Alexis. That's pretty cool. Pretty cool.
I'm into it, absolutely. So we'll have to see, when exactly they go public, if they're able to build on that momentum.
All right, let's leave it there. Our series examining the impact of climate change continues this week with a look at how mounting climate-related claims are forcing insurance companies to rethink their business models. Yahoo Finance's Akiko Fujita joins us now. Akiko?
Well, Brian, insurance companies have always been in the business of managing risks, but the scale of those climate-related risks and the costs associated with them are upending traditional business models, and that's particularly true in California.
I saw the flames. I called him. I told him, don't come this way. It was on fire.
This is what's left of Becky and Lee Nelson's home.
You'd come into the dining area and the kitchen was up front here.
A dream home built over 4 decades.
Nice big closet, 8-foot by 15-foot closet.
Yeah, my closet was cool. It was the best closet ever.
Now an empty plot of land.
What did the space represent to you?
40 years of hard work. It was really comfortable here.
That all changed with a campfire November 2018, the worst fire in California history. Flames that tore through this community were so fierce, it devoured 95% of it in a matter of hours. Paradise lost nearly 19,000 homes that day. 85 people were killed. Becky's sister was one of them.
When the chaplain came to tell me about her passing in the fire, I asked about that, and I said, when did you get the call to get her? And he said 9:30 that day. And I said, and when did you get to her? And he said Saturday, 3 days later.
All this was built up, like commercial things on both sides. There's a hotel over there.
Lawyer Joe Early says slow insurance payouts have dragged recovery here. He's helping thousands of residents file their paperwork.
So this was our front door.
Even as he looks to claim his own losses, including his home.
You have to stay involved, deeply involved. You have to look at your policy, for instance. You have to read that policy and say, wait a minute, we have coverage for this, or you're not including this, you're ignoring that. How do most people do that? They've never looked at their insurance policies before. It's not easy. I mean, I'm a lawyer, and I look at that and go, what are you trying to say?
Those with insurance are considered lucky. Wildfire victims are being victimized again as insurance companies begin to drop policies of those most exposed to the fire risk.
There's no doubt that we've had a record number of filings from insurance companies who are now trying to reassess their portfolios. The fact is, over the last couple of years, there's been close to $25 billion in losses for the insurance industry. We hear stories over and over again of so many Californians investing thousands of dollars in their property, and yet they still get dropped from their insurance company.
Insured losses for global natural disasters topped $225 billion in 2018, one of the costliest years on record.
We're focusing on the 4 primary natural catastrophes.
Sean Kevlin with the Insurance Information Institute says insurance companies are scrambling to update their risk models amid soaring losses.
Loss costs have increased from the 80s over 660%. So for insurers, we've been in the business of managing risk for 300 years. So this is an increasing risk. How do we help ourselves in terms of our business and make sure we're operating our businesses right? But more so, how do we help the customer and make the customer more resilient in these increasing risks?
Those risks prompted Insurance Commissioner Lara to impose a 1-year moratorium in December, banning insurers from dropping customers. He's now partnering with the United Nations to develop a sustainable insurance roadmap for other governments to follow.
Looking at what are proper investments for insurance companies to be doing to get us to our Paris Climate Accord agreement. And also, what are divestments that we want? What are underwriting guidelines? Should we be underwriting maybe coal facilities in California?
Back in paradise, few are returning to rebuild. Its population is just 1/3 of what it was, with much of the town in limbo, just like Becky and Lee.
You planning to rebuild here?
We haven't decided. We really didn't have enough coverage to handle all that and put our house back in its original form. So it's a bit of a mountain to climb.
Now, insurance carriers are now juggling a new risk associated with the coronavirus. Lloyd's, for example, says it expects to pay out anywhere from $3 to $4.3 billion to its customers stemming from the impact of this pandemic. But that, of course, pales in comparison to the impact from climate risks. Lost costs stemming from natural disasters last year alone topped $146 billion.
Wow, just an incredible story. You obviously went out and shot that on location before the pandemic. What do you think the pandemic is going to do to these insurance companies as it puts an even deeper strain on them? Might we see some of these insurance companies really get into trouble, Akiko?
Well, I think that's certainly what can be expected. We were expecting that even before the pandemic. So this really is just kind of a double whammy for these insurance companies, because as I pointed out there, the climate risk isn't going away. And so when you think about small businesses, for example, looking for some kind of insurance payout as they look to their closures, you're certainly seeing homeowners not being able to pay as well. That's an added layer of concern for these insurance companies who are already trying to scramble to update their business models.
All right, Akiko Fujita, thanks so much. Be sure to watch Yahoo Finance next Tuesday when we conclude our climate crisis series and investigate the economic impact of big data and how everything you store in the cloud has an environmental cost. Much more ahead on these rallying markets on the First Trade. Welcome back to the First Trade. Some uplifting news to come out of the coronavirus outbreak. A new study found that Americans have picked up better spending and saving habits during the pandemic and have rediscovered the joy of spending time with one another without spending a whole lot of bucks. Joining us now to discuss is Keith Dennerstein of TD Ameritrade. Keith, good to speak with you. Really interesting survey here. my takeaway is that they're finally saving money. Good.
That is one of the big takeaways. We just came out of what was supposed to be a once in a lifetime financial downturn with the Great Recession. And the one great thing that people did to take advantage of that was to really build up a lot of good financial habits. So they were regularly contributing to savings accounts. They had built emergency funds. They were creating household budgets. Now, of course, the pandemic has set a lot of people back, but it's also showcased the resiliency and the resourcefulness of Americans and really allow them to get back in touch with their finances.
You mentioned, let me just jump in there. You mentioned emergency funds. How much have they built up in terms of emergency funds, and how long would they last?
Most people have had, and what we would suggest is having at least 6 months worth of savings in your emergency fund. And what we found is that particularly for older Americans, they did have that much. Now, when it comes to younger Americans and particularly millennials, a lot of them were lagging in terms of the amount of money they had saved up in their emergency funds. So we found that
What's up, Keki? I just made an account.
did have less than 3
Can you help
months
me
worth
out?
of savings. So they were really taken
All right,
aback by
so
this downturn.
what you need
But
help
the
with,
bright
or is
side
it the
of that is
giveaway?
that
You
a
would
lot of them
type,
have actually turned out during
well,
this downturn to
first
be better off
you have to
financially
type
than before,
exclamation
doing
mark
things like
tickets.
taking on side hustles
But in order for you
and
to get tickets,
really
you have to have
getting back
points.
into
In
touch
order
with
for you
their
to get points, you
finances,
have to watch
creating
my
household
stream
budgets if they didn't have one, so that
for
they
a
could
certain
be
amount of
in a
time.
better shape
So I believe
should
it's like
something
10
like this
points
ever
for every
happen
5
again,
minutes
or
or so.
if there is any sort of downturn within their lives.
But you don't have to like
Keith Espere here. Americans
continuously
got a
watch it. You can like
stimulus
leave it
check,
up
and it seems
at
from
works.
what AutoZone, for example, today was saying was that they were
So like if
spending
you
that
just leave it up
stimulus
and mute it
money.
in the
If they
background, you
get
can get
another
points for that
round
credit
of
too.
checks, do you expect them to be putting it into savings or to be spending it?
They were using what we found is that people are using that stimulus money in very good ways, doing what we would want them to be doing. The reason we give the stimulus is so that they can take care of their household expenses. They could pay off their rent, but they are using any excess funds for the financial betterment steps that we would want them to be taking. So yes, they are putting some of that money in savings funds. They are paying down debt. They're doing the things that they should be doing, cutting back on some frivolous spending, whether that be going out, buying clothes. Now, of course, we do want to spend money on things that make us feel good. But the one thing that we've learned is that you don't need to spend a lot of money in order to have a good time. So really repurposing the money towards where it's really needed. And that's what most people are doing with this money.
And do you notice any difference in age groups as far as younger generations and older generations with what they're saving?
So what we found is that the younger generations really are using a larger portion of this money to do things like pay down debt, to start up savings accounts and emergency funds, which is what we would want to be seeing. Now, the older generations are using this money to more take care of themselves, to do things like take care of their household finances. A lot of them, especially a lot of parents, are now using some of that money to take care of education and entertainment for their children. Because with daycare being closed, of course, they want to repurpose some of that daycare money to some of the activities that they need to take care of with children at being at home.
Keith, amidst all this, are people buying more American-made products?
What we found is that they are buying not just more American products, but shopping more locally. The one thing that this has done, and with so many of us really confined to the areas right around our home, is really respect our communities so much more. So what we find is that Americans are shopping locally. They're respecting and tipping their service workers in their community. And yes, they are buying American as a result of this sense of community that people are building up from the pandemic and from really being reflective during a crisis time like this.
Keith, how worried are you that a lot of these spending habits these savings habits simply go away? To be honest with you, I want to go out and buy a new suit. And when I get ready to go back to work at some point this year in the office, I'm going to go out and buy that suit.
Well, that's fine. And that is what we want to see ultimately. Initially, we do want people taking care of the necessities in their lives, and we are finding that they're doing that. Whether it's, as I mentioned before, household expenses, groceries, cleaning products. But yes, when we get a step beyond that, household consumption and consumer goods are so much a part of our economy. That's what we need to get things rolling again. So once people are on solid financial footing, there's no reason not to go out and buy that suit or spend money on some of the things that you really do want that you might have been putting off because of this downturn.
All right, let's leave it there. Keith Dinnerstein of TD Ameritrade. I will be going out and buying that suit.
Go for it.
All right, we'll talk to you soon.
Thanks.
All right, let's get right back to Ines Ferre for another look at the markets. Ines?
And Brian, the S&P is above the 3,000 level again. We're looking at financials and industrials and energy, which are leading the gains today. And the rally is also fueled by hopes of a vaccine. So let's take a look right now at Novavax after the company said that it has started phase 1 of its clinical trial of its vaccine candidate for COVID-19 in Australia. Preliminary results are expected to come in July after phase 1. Phase 2 trials will start in several countries, including the United States. Also, take a look at year to date, this stock, unbelievable. Also looking at Merck. Merck is up more than 2%. The company says it is going in full force to develop a vaccine for COVID-19. It struck a deal to buy Themis, a private company focused on a pipeline of vaccines. It also announced a partnership with a nonprofit vaccine research organization, and it's collaborating with a company called Ridgeback Biotherapeutics to develop a treatment for COVID-19 patients. And then just taking a look today at some of the airline stocks, because they are really soaring as more states reopen their economies. Also, some encouraging headlines from Europe as Germany plans to lift its travel warning on 31 European countries. So you've got also European airlines that have also been soaring today. But just taking a look at the American ones today, you can see Southwest up more than 11%, Delta up more than 10%, American up more than 11%. Now, LATAM Airlines this morning in pre-market, it was halted for trading after LATAM says that it is filing for bankruptcy protection. Year to date, this stock is down 74%. Last year, Delta invested $1.9 billion to take a 20% stake in LATAM. Brian?
All right. Thanks so much, Ines. And quick final thought for me. We just had Target CEO and Chairman CEO Brian Cornell on the program. Says pretty much May sales have continued to be strong, joining a long list of a lot of retailers like a Walmart, suggesting people are taking their stimulus checks and going out and buying stuff, whether that's good or bad, unsure, but it is good to see nonetheless from an economic standpoint. But do stick around, much more ahead on the markets, stocks, you name it, on the move. That's next.
Would have been nice if I can get on this American airline. Guess I'll miss it. I mean, I got in, but I want to buy more shares here. But it's all good.
Happy Tuesday to you. It is May 26th. I'm Adam Shapiro along with Julie Hyman. This is Yahoo Finance on the Move. And take a look. It was New York Governor Andrew Cuomo who rang the opening bell down at the New York Stock Exchange this morning as traders returned to the floor in limited numbers with new protocols for protection to the floor of the stock exchange. We're going to talk about that. And then these markets, the S&P 500 and the Dow, both trading at highs we've not seen since March. S&P 500 over 3,000, the Dow over 25,000. NASDAQ is up as well, about 1.4%. And then oil is trading higher, almost $34 a barrel. Some of the headlines that are moving these markets have to do with this. Novavax says it has started phase 1 clinical trials of its coronavirus vaccine. Preliminary results should be ready in July. Also, Merck announcing it's buying an Austrian vaccine maker. We're going to hit all of this in just a minute. Hertz filed for bankruptcy protection over the weekend as lockdown-weary Americans flocked to beaches and open spaces, some without masks. We'll take a look at what happens next. Also, U.S. house prices rose in the first quarter of 2020, up 1.7%, according to the FHFA. House price index rose 5.7% year over year. The S&P CoreLogic Case-Shiller 20-city home price index, it saw prices increase on a national level of 4.4% in March. That was up from 4.2% in February. We're going to break down those numbers a little bit later on with an expert who may have some caution about that. Conference Board consumer confidence number in May, it was up 86.6 from April's 85.7. And the Commerce Department says that new home sales increased 0.6% last month to an adjusted annual rate of 623,000 units. Taking a look at the number of coronavirus cases worldwide, 5.5 million now testing positive, with the number of dead exceeding 348,000. Here in the United States, we have a little bit more than 1.6 million people testing positive, with the number of dead slightly over 98,000. To help us understand what's going on with coronavirus and this news from Novavax, Anjali Khemlani joins us with the latest. Anjali?
Thanks, Adam. Yes, so as you mentioned, Novavax entering into that phase 1 trial in Australia with those participants and hoping to get into phase 2 by July, and anticipating possibly having the results to prove efficacy to get emergency use by August, or at least some sort of deployment, is what the president of R&D told us earlier today. And so that also is in addition to ramping up production to 100 million doses by the end of the year and 1 billion by next year, which is pretty much on par of what we've heard. Novavax has received the largest amount of funding from CEPI, which is a European nonprofit backed by the Bill and Melinda Gates Foundation, to help produce this and to help ramp it up. And this is, just another sort of a milestone for a biotech, which is really the sector that's getting a lot of prominence through this vaccine race. Meanwhile, Merck, as you mentioned, also number one, buying outright a vaccine producer, as well as announcing plans to partner with another nonprofit to develop vaccines for the coronavirus. And that sort of rounds out the news of larger pharmaceuticals that we saw, and especially the top players in the vaccine race, including Johnson & Johnson, Sanofi, GlaxoSmithKline, and others, and Pfizer, who are in the race now. And so this sort of makes sure that the top 5 are now in the race. So positive news there. Definitely waiting to see, how this all gets along. The two vaccine productions today, so from Novavax and Merck, are a specific type of technology and newer technology as well that we'll wait to see, what it proves in terms of efficacy. Adam.
Anjali, thank you very much. Let's bring in Paul Schatz. He is the president of Heritage Capital. And to help us grill you, Paul, I want to let everyone know that Melody Hammond and Ez Ferre are here. But when we watch these markets trade higher, especially on this vaccine news, I got to ask you, is this a fake out? Are we really up and going forward, or might we hit lows again?
And good morning to all of you. So my thesis has been that since the middle of April, except for the NASDAQ, which is trading on a mind of its own, the Dow, the S&P, the mids, the smalls have all been in a trading range. They've been in a band, and we've been bouncing around from the lower end of the band, the upper end of the band. Last Friday, I wrote that I thought with one more rally, with one more pop above the most recent range, I thought the market could see some kind of short-term peak. And I didn't expect to wake up on Tuesday morning or actually Monday and see the Novavax news. But whatever the case may be, we've certainly had our share of Monday or first day of the week upside surprises. This is another one. I think, look, when you've been in a range for so long, and it's been almost a month and a half, and so many people have seen the same range that I have, many times, to your point, Adam, you pop above the range and then you immediately pull back into the range. So you can see a fake out. I don't think the market, while I do think we're going to 30,000 next year and 40,000 by 2023, I don't think this is the beginning of the run to new highs right here. I think we need some pause and digestion first.
Hey, Paul, it's Julie. So we have been in a range, but it's a range where we have consistently made higher highs, right? It's a range that has a very slight upward bias within it. And so I'm curious if, looking at things like vaccine development news, like economic data, I mean, today we got new home sales, for example, that came in better than estimated. Consumer confidence that came in better than estimated. So on a fundamental basis, is that upward bias justified?
Things are less bad. If you notice, Julie, every really bad economics report, markets screamed higher, which is pretty amazing in and of itself, because I've said this so many times. For trading and investing, it's not so much what the news is, but how the markets react. So the most bullish thing a market can do is go up in the face of bad news. This is a very embryonic bull market. And I think the last survey I saw, 68% of people polled said this was nothing but a bear market rally. That's why we keep going higher. The S&P 500 has had a slight upward bias, but really the Dow, the mids, the smalls have almost been this perfectly flat range across the top. Is it justified? Sure. I mean, you know, I think this will be the only lockdown of the entire economy we see the rest of our lives. I think a lot of things were learned, and I do not believe we will ever have a nationwide lockdown again, given what we learned. So if you think some semblance of the economy will get back to normalcy, a third, a quarter, 40%, you have to, the key is divide your investments into the haves and the have-nots. The haves, like technology, absolutely ripped off the bottom. But in the last couple of days, what have we seen? We've seen rotation out of technology, out of the Amazons, out of the Facebooks, and into some of the banks are strong today, the industrial, some of the more economically sensitive value, which has been left for dead years and years and years, value is percolating. So you're seeing a lot of constructive signs. My point is, I think whatever decline we're going to get, we're getting between now and the end of Q2, and then things will even get back to more normalcy as we get over the summer.
Pauline Esperet here. And as you talk about getting over through the summer, what do you see the biggest risks going forward? Is it a vaccine not coming through by the end of the year? Would it be China-US relations? Would it be the outcome of the elections? What do you see as being the biggest risk?
Boy, and there's a lot there that we may have to worry about. Look, so you have the smartest people on the face of the earth all working towards a vaccine. I would bet an awful lot of money, at least one entity will have a vaccine by Q1 of 2021. So I don't think that's the news will be back and forth on who has what. The China thing, it's an election year. I think this is just saber rattling from Donald Trump to generate some more enthusiasm from his base because he can't have those big rallies. To me, the biggest risk is a less percent of the people in the country will go out and spend money. I think that's what I'm most, and frankly, because I'm probably a little more cautious than most in my habits. And so I always look and see what everyone else is doing around me. I think that's the biggest risk, is that less than whatever number, 2/3, half, 40% actually go back to restaurants and social scenes and retailers and actually spend their money. So the other stuff would be secondary.
So Paul, boil this down. When you talked about value percolating, and you also talk about the have-not sectors should lead in the next rally, going forward, which are those sectors? Where do you see? I heard you mention banks. Is it financials or is it something else?
Yeah, that's right. So I want to be clear. The have-nots are the ones that have the most risk. Things like airlines and hotels and cruise ships, etc. Banks are part of that because banks have a lot of loans out to the have-nots, and the concern is that they're going to have to build more reserves. So the key for me on banks is, and we're very light on banks, but the key for me would be if we start to see some big banks cut dividends, that'd be a bell ringer to buy banks. I think this is the kitchen sink quarter. So those are the ones where I'd want to get involved. I'm not going to buy the cruise lines. I'm not. And a lot of the have-nots, I'll only look at best in breed, the strongest have-not, like JP Morgan. In the airline space, I don't love the airlines. I've railed on them with you guys time and time again, but the strongest airline is Delta. So if you have to look at the have-nots, look at the best in breed. Don't go out on a limb and hope to hit 1,000% gain in some beaten down stock at $2.
We don't have time for me to take issue with their call on Delta because I would say Southwest is actually perhaps in a better position. But Paul Schatz, thank you so much for joining us.
Good to see you guys.
Heritage Capital. We're going to pick it up on that next time, Paul. Be well, buddy.
Count on it.
All right, let's talk about something else which is getting headlines right now, and that has to do with the potential for a new Cold War with China. We welcome into the program Carson Block. He is the founder and CIO from Muddy Waters. We appreciate your being here. And China trying to make hay of the fact that there may be legislation requiring their firms to be held to the same standards, accounting standards, as U.S. firms, but they're threatening to delist, perhaps, from U.S. exchanges. Carson, what do you make of all this?
Well, I think it's actually really funny that China is pushing back on this. The bill that passed the Senate last week is actually, it's a very kid-gloves bill in terms of how China is treated here. And there are two reasons for that. Number one, or two reasons I say that. Number one, the bill allows China 3 years to come into compliance, which would mean to allow the PCAOB, that's the Public Company Accounting Oversight Board, to inspect PRC-based auditors of U.S. listed companies. So that's basically the same standard that applies to almost every other company listed in the U.S. The PCAOB may inspect their auditors. China has not ever allowed that to happen. That's number one. Number two, the bill doesn't even mention how China upped the ante majorly in this year. Now, before I get into that, I just want to state, and we don't have to dwell on it, but literally hundreds of companies from China have listed in the U.S., raised money, and either been exposed as frauds or just stopped filing because they were frauds and they'd already taken their money. And literally not one PRC national who chaired one of these companies has ever been materially punished. At the end of the day, the best CS.
I'm sorry, if I could just chime in for a moment, because I know that your sort of bread and butter and your expertise has been in singling out some of these companies, in some cases very profitably when you've shorted them. And you've worked on a company by company basis. What do you think would be most effective, though, on a larger level? I mean, if this legislation isn't effective, and by the way, it's not even clear it's going to get through, right? What would be the most effective approach?
Well, okay, so what converges on the answer to that question is also the other thing that China did here, which was this year a revised securities law went into effect in China. And under that securities law, they said for the first time that China government, that's the China Securities Regulatory Commission, has jurisdiction over China-based companies that issue stock overseas. Now that's kind of weird because if they're not issuing it domestically, that's new, where China says, okay, we have jurisdiction. But then this new Article 177 says no China-based company that issues stock overseas is allowed to provide an investigator or enforcement body from overseas with any information without express approval from the CSRC. So China has just codified in law that a company that's under investigation from China may not cooperate with the investigators in the U.S. So what's needed here? Well, I mean, if we really want to go down the rabbit hole, and a lot of people, who don't have the background in China that I have are kind of shocked when I say this, but a large percentage of companies from China listed in America are committing at least some level of fraud. And that's because they can get away with it. Again, you go back to that fact that nobody has ever been materially punished. No PRC national who chaired one of these companies has ever done prison time, and they've settled for pennies on the dollar that they've stolen because that's all the SEC can get out of them. So when you have that kind of asymmetry of risk reward, well, that basically says to somebody sitting in China, hey, if I go lie about my financials, raise money in the U.S., well, if it works, I can make tens or hundreds of millions of dollars. And if it doesn't work, well, I mean, I'm no worse off than I was before.
Carson?
So that's one reason.
But what happens to, I mean, if we have this new Cold War, I think it's the foreign minister in China has actually said that this is what's happening. Who's going to wind up getting hurt most? For instance, if I'm invested in Apple or even Tesla, China, you would expect, would retaliate. So what are you worried about as far as investors who might be invested in U.S. companies that need access to the world's largest market?
Okay, so that brings up the point that what's going on in capital markets and also what's going on with multinationals is one prong of a very well thought out strategy by China. And what China wants is China wants to replace the U.S. as the world's preeminent economic and, in many parts of the world, political power. Now, one way that it's been very effective in doing this is by co-opting American elites. So whether these are at universities or leaders of industry. So Apple and other companies have gotten themselves so deeply entangled in China that whenever, that their interest clearly is in influencing the U.S. to overlook China's transgressions. And this creates a real problem. That's why the problems that we have with China have spun as far out of control as they have. It's because you've had kind of apologists for China, but they were really talking their book or protecting their book, influencing policy. So we're at a moment right now where it's, there's maybe equal, there's equal, I guess, force on both sides. You have, I think, a tremendous amount of populism coming into, or populist sentiment coming into this year, rising against China. And then that's massively compounded by COVID-19 and how China has comported itself there. So I really am trying to answer the question as to what I think is going to happen afterward. Do the multinationals and the finance industry, which really likes the openness of our capital markets to China, do they win again in terms of their influence in policymaking circles, or is something so profound underway right now that the paradigm post-COVID will be, much more distance economically between us and China, and will the elites that have, really advanced China's interests in the U.S., will they find themselves somewhat marginalized from these conversations? So,
and Carson, yeah, Melody Hom here. When you think about some of the ways that China is trying to at least appear more open, we saw earlier this week Alibaba listing in Hong Kong, and more of these laxer regulations, and Hong Kong and China trying to be more open, allowing dual class structures, allowing companies that are listed in the US to offer those secondary listings. Do you anticipate that going forward, some of those behemoths will choose to just list in China to begin with? Will there be this, okay, we have to do the NYSE first and then eventually go elsewhere?
Yeah, I think that from their perspective, I mean, they really do need a backup to the U.S. markets. I mean, if, at the very least, the situation is becoming unstable for them. But, and I know the president has made the comment, well, if we close off the markets to China companies, they'll list anyway, and our capital will flow there anyway, but somebody else will benefit from the listings. And I think the reality is if these companies list in Hong Kong or London, although I honestly don't know that London will really take a lot of them right now, but if they were to do that, institutional capital could follow, although I think it's an important signaling mechanism if they're locked out of the U.S. market.
Yo, what's up, man? No, I had my mic muted. I was streaming this since early this morning. I'm here. Sometimes I'll mute my mic and walk around and do some craziness. I'm still here, just chilling right now. Let me see. Marcus looking good as always. I don't know, man. I might just still hop in there, American Airlines. That American Airlines look tasty too, boy. But I'm gonna see. I'm gonna see. Verizon. I just got into this one. I got into Verizon at what price did I get in at? See, they don't be trying to tell me nothing, man. Hold on. Oh, that's my sell trade. I ain't trying to sell it yet. Let's see. Oh, I got in this one at 54.91. It's at 55. I'm already in profit. I think I'm gonna take this out right here at 57. I ain't gonna be greedy. I mean, I could ride this all the way up to 58, but I'll be all right. You know, sometimes you gotta be patient. Let me check this weekly chart real quick. Nah, see, I got a lot of room to go up too. Based off the weekly, that's a lot of room to go up. I could have bought more and just be patient and ride it all the way up. I mean, that's what I've been doing the whole time anyway. It's the coronavirus right here. I should have bought more. It's all good though. It's all good.
So
I just
maybe
realized
not
my
as
news was
much,
turned off.
but I think the Chinese companies will definitely look at Hong Kong as a backup because the situation in the U.S. is becoming unstable for them.
A lot of us pay very close attention to what you do and what you say. Carson Block, founder and CIO of Muddy Waters, thank you for being here on The Move. We're going to be right back after this.
Thanks.
Today just looks so good for me, man. Like, let me see. Like, today just looks so good for me, man. Oh, wow. I just realized my Spirit Airline went to $12. Damn. I'm getting paid without knowing it. That's how you know you good. When you got to remind yourself you're getting paid. I'm back. What stocks do you have? I be getting in and out the markets, man. I got all kinds though. Let's see. So I have something called Robinhood. Well, first I'm trading through my bank. So on my bank, I have Alibaba, American Airlines, AT&T, Carnival Cruise Line, Disney, ExxonMobil, Front Yard Residential Corp, General Electric, Iron Mountain, Shift, Pixie, Spirit Airlines, Zora, and then I remember because I followed your page a little bit. I remember, man. And on my Robinhood account, I just got oil, U.S. oil. That's the only thing I got different on that one. But sometimes I trade. See, at first I used to trade invest is what they use the term that they call it, when you buy and just hold the stock for long term. But instead of just doing that, I decided to shift over to just trading. So buying and selling when you can get it. Check out Penn Gaming.
Welcome back to Yahoo Finance on the Move. What's old is new again as the S&P 500 and Dow hit highs we have not seen since early March before the pandemic lockdown. Something else that has happened this morning. Trading resumed on the floor of the New York Stock Exchange, and we spoke here on Yahoo Finance with NYSE President Stacey Cunningham.
It's time for us to start to reopen our economy, to start to reopen America, but to do it cautiously and to do it with everything we've learned about this virus and how to protect ourselves. And we protect ourselves by protecting others around us. So while we are reopening, this is not back to business as usual. I'm wearing a mask. That's really important. As I saw some of the video footage over the weekend of people in locations that are reopening, they need to make sure that they're still using the protective measures that we've learned that are so important and so critical during this time. Otherwise, the whole fact that we've been shut down for 2 months
let me turn
will
the
be a
sound
waste
off.
if we don't continue to be cautious and continue to protect ourselves.
1 second. Let me make sure this is live.
I imagine there are many.
I've always been a businessman. It's just throughout the years. Oh, look, Microsoft. I ain't gonna waste my time with that. I've always been a businessman growing up. It's just throughout the years I got smarter. Smart at making money. I'm not smart in school. I still get F's, but that's fine. I remember when I went back to school, I told myself I'm gonna become a better person. Didn't work out. Oh, look at that, American Airlines. Come on, just get up there and stop playing with my money. You say, yeah, you smart, but your teammates weren't. That's how it be sometimes. That's how it be sometimes, man. Sometimes you just gotta take the L with the team, man. You gotta figure out how to make that W. See, I'm all over the place with making money. I got this. I got, I do my websites on the side. Actually, I think I want to pull this out. I want to pull this out and add something to it. I'm gonna add that change sample. There we go. That'll give me a better look. Hold on 1 second. Let me see something. Oh, I'm gonna pull this over some. How does this only thing I did was keep on saving. You talking about the stock market? So it's a lot of stuff involved with the stock market, man. So saving is good. I have some stocks that I save for. Mine's are AT&T because of the dividends. Like my saving stocks or my dividend stocks, I might trade them in the long run, but I ain't sure yet. But for now, I'm trading everything except for my ones with high dividends. Those are the ones that I'm invested in for the long term. So those are the ones that's going to pay me without me knowing, because it's going to keep running you a check. Like one day I might not feel like trading, or I don't know, I might get deployed overseas or something crazy. And while I'm overseas, the money don't stop. See what I'm saying? Like I can't trade like I do now, but when I go over there, at least the money won't stop. But so basically, I'll show you. I'll give you an example of what I did this morning actually. So all right, so I'm pull up. Let's see. We'll use this chart right here. All right, so this is Carnival Cruise Line. You know about Carnival Cruise Line, right? The Diamond Princess, the one that was over, I think, in California or something like that. The one that people had to stay on the cruise for like 2 weeks or something because everybody had coronavirus. You know what I'm talking about? Mark this up real quick. What's up, Swag Gamer? So, is investing better than saving? Man, listen, investing is better than going to college. College is a waste of time. Investing is way better than saving. By far. I ain't a hustler of the year for nothing. I'm gonna let that do what it do. I already sold this. I've been sold this one. So on this one, I got in. See, what people don't understand is people always say, I want to buy the bottom, but you're never going to use the bottom. So just keep buying and buying and buying and buying. And then when it came up here, I sold. So I'm waiting on it to come back down here again so I can buy more, come back up, sold. It might not come back down because, they're talking about a cure coming out and all that stuff. But if it don't go back down, I was gonna try to invest, but I don't know how this stuff works. Well, you came to the right place, my friend. You came to the right place, man. That's what I do. I invest. I trade. I trade and I invest. Difference is investing is when you invest into a company for long term, for long term gain. Trading is when you get into a company and then when it goes up, you get out. So, for example, I got in the Carnival Cruise Line at $9 per share, went up, sold. That's what I did this morning. I sold, and then I'm waiting on it to either form another pattern or come back down. One of the two. That's normally what I do. I wait till it form another pattern, and I hop in on the pattern. So if you look at all the stocks that I own over here, I'm in profit on every single stock except for two. You say, how much does it sell for? How much does it sell for? It depends on the stock that you get. So, for example, Carnival, like I said, I got in. multiple times really. So I got it. I bought let's see. I bought like if I hoover over this right here, I bought 376 shares at $11. Then I bought another how many shares did I bought? Well, one, that's it. At $9.98 or $9.99. You know, and then it went to $16. So, you know, going from or $11 to $16, you sell it at 16. So basically, let's see. I know I bought more than that. It just I don't know. I think maybe this is stopping me, but I bought more than that, right? So basically, let me see if I can get you an average. All right. So on average, I bought 576 shares for $10 right here on the left side of my screen. On average, I bought 576 shares for $10.78, right? And I sold it for $15.80 because you know you don't want to get it was up here and I didn't want to let it pull back and I miss it, so I sold it. So instead of paying $10.78 times 576, that's how much I paid. I got paid back $15.80 times 576. But it all depends on the stock that you're buying. Like every stock is different. So like, I've also sold my Disney shares. I have for Disney. I bought I think 13. I had more than that. I think I had 51 shares. I had 51 shares. Yeah, see right here, 51. I had 51 shares of Disney at $96. Went to 121 and I sold all 51 shares at 121. Bought them at 96. You can do it quicker than that though. Some people can do it in a day. I like to do mine over time. That way I can invest more, and the longer the time frame, the stronger the trend. It took a lot of learning to figure all this stuff out. 51, but yeah, that's how much you made. Yeah, from Disney. That's just from Disney. That's just from Disney. You know what I'm saying? Remember now, I bought on the left side right here, I had, for 10, I had 576 shares of Carnival that I sold for $15.80. So, those were two trades I did today. Yeah, that's what I'm saying. Stop playing, man. College ain't gonna help you, man. I'm telling you. Only thing college do is stress you out. Every time I hear the word test, I get stressed out. Like at least when I had to do homework, I can Google the answer. My teacher told me I can't make it through life Googling everything. Googling got me to the stock market, making it through life just like that. See, this right here on the right side, right here where it says return on your investment. This shows you the percentage of return that I have. I'm only this Zuo. I've been sold this one. I sold this at $12. That's why it's red because I've already sold it. I sold this one Friday. That's why it looks like that. But the other ones I showed you, Disney and Carnival, I sold this morning. So it's giving the market time to see it or something like that. I don't know. But as you can see, of all these trades I have more on my Robinhood account. But here, I'm only bad on two trades: American Airlines and this one right here. That's it. Like, I ain't worried about that. This one, I'm up 50%. Carnival, I was 50% return on my investment. You can't beat that. All I did was give somebody some money, they flip it, give it back. That's it. You can't beat that. That's why you always see me playing video games all the time. Like, why get a job when I can sit home and play video games and give people my money to make for me? I ain't gonna let no Rona stop me. If anything, it made it easier for me. Some of these stocks I don't got that much shares in, just because I didn't know what was gonna happen. I was just throwing some shares at it just to see what was gonna happen. Currently, I got you, bro. I got you, man. McDonald's. See, a lot of these other ones expensive. Man. Right now, pay for all that. Let me see, Dunkin' Donuts. Hey, I heard Dunkin' Donuts was good. I typed that right? No, I didn't. Oh, oh. I got into this one. This is Spirit Airlines. I got into this on Friday, like Friday. You see this P right here? 522, and I'm already up 20%. Your bank don't even give you 20%, man. Your bank give you what 0.0001%. That's not even a number. That's you know what I mean. That's not even a number. It's not even a number, man. Let me see what else they got going on. See some of these other ones, man. Let me see. I think I'm Nah, I ain't messing with this one. This one like is about to go bankrupt. What's Uber looking like? Nah, I don't want to mess with that either. Uber actually don't look bad. It's not actually not that bad. It's actually not that bad. Let me see. If I get in this one, I'd get in. I don't know. It's on the uptrend. That's a good thing. I think I would get in about right here, 33. I keep my eye on it. I don't even know what this company is. I would get in on this one. The chart look good, but I don't know what the company is. Let's see. This do seem like a good buy area too. How much is this? $6? Hold on. I ain't gonna buy this. This is oh no. I ain't buying that. That's at all time high. So you don't buy at all time highs, man. It's fucking okey doke. I almost set myself up. I had to zoom out on that one. I'll mark it though. Damn, they got a stock named Snap. First thing I pop in my head is EBT. Well, how much this is? $80. Let me take a closer look at this one. A lot of people use Square. Let me take a look at this oil one more time. $23. See. I'll take a buyout. Why not? I'll take a buy right there. I'll keep my eye on it. I don't think we're gonna hit this number again. Damn, that oil ain't playing today. I might go ahead and buy some now, and then we'll see. I don't know how far down this is gonna go. Let's see. This is at 20, 22. I'll probably just buy here at 20 and call it even.
Welcome back to On the Move. We are watching markets right now, and the man who keeps his eye on that for us at this moment is Jared Blickery. What's driving these markets up, Jared?
Well, we have financials, industrials, energy all outperforming. So really those cyclical and value names, you could say it's short covering, and it is a little bit troubling that we don't have tech participating, but it is only the beginning of the week. We can see the Dow is up nearly 600 points. It is the outperformer, up over 2.39% right now. And you can see really holding on to most of its gains. The NASDAQ is kind of the opposite here, giving back most of its gains from the Friday close, and the S&P 500 kind of in the middle here. I do want to take a look at the Russell 2000. That's up nearly 3%. Small caps, transports, all outperforming as we see the 10-year T-note yield is up, and let's see how much it is up now, about 5 basis points. Just taking a look at the year-to-date chart on that, we can see still in this range that we've carved out for several months, but the S&P 500, which I'm going to go back to, has now punched above its previous 2.5-month trading range and is right at its 200-day moving average. Bulls are going to want to see it close above 3,000 today. Giving back any gains and closing back under 3,000 could be a negative development in the short term. We'll have to see what happens there. Also want to check out the price of crude oil. Now this hit about $35 per barrel earlier on, but it's running up resistance that it's had since about March of this year. See if it can punch through there. Gold and silver both retreating as well. We did have this breakout actually 2 weeks ago, and we're just coming kind of down to the breakout level. We do want to hold above about 1,700 there. Theoretically, we might have a double top forming, but too early to tell. The neckline, again, right here, just below 1,700. Let's take a look at our heat map, and we can see lots of green on the Dow here, but tech really just not kicking it today. Microsoft down about 20 basis points, Apple just underwater. Financials really carrying the water today. Regional banks doing well, and so are the big money center, JP Morgan Chase up about 6%. So is Boeing. Industrials really moving as well. That's up about 4% today. Looking at the NASDAQ, we have lots of green here too, but kind of more of a mixed board here. Some of the big name stocks that are doing well. Facebook hit another record high this morning. Alphabet up about 1.2% here. Netflix underwater at about 3%. And if we sort by performance, we can see some of the biggest winners here, like United and American Airlines, are up 13 and 12% respectively. Those are the most beaten down stocks in this rally. Also Expedia and Wynn. So it is a little bit of short covering coming on today, but we'll have to see where we close, Adam.
Jared Blickery, thank you very much. Don't go anywhere as we watch this market rally. Julie Hyman is standing by to take us into the next hour of Yahoo Finance on the Move.
You're watching On the Move on Yahoo Finance. I'm Julie Hyman, joined by my co-host Adam Shapiro. Dan Roberts and Jessica Smith are also going to chime in over the next hour. We've got a rally today that is sending the S&P 500 above 3,000 for the first time since early March. Right now, it's up about 1 2/3%. The Dow really surging today. It's up 2.4% and above 25,000. The NASDAQ up about 0.75%. It's a little bit unusual as of late for it to be the lagging of the three major averages. A few headlines to bring you at this hour. The New York Stock Exchange is reopening today with diminished capacity. Only 25% of the normal number of traders are on the floor, but remember, it has been closed since March 23rd. One of the things that is helping stocks higher today, a couple of developments on the vaccine front. Novavax has started a phase 1 trial of its vaccine in Australia. Also, Merck making a purchase, buying a company called Themis to gain a vaccine candidate that's in development. It's also partnering with a nonprofit in order to try to develop a vaccine. We got some economic data, in particular, new home sales unexpectedly rising month over month by 0.6% last month to an annual pace of 623,000. And consumer confidence is going up, and it is also better than estimated. The Conference Board's figure coming in at 86.6 for the month of May. So all of that helping in part to buoy stocks in today's session. In addition to that, we have more reopenings going on over the Memorial Day weekend. A lot of people flocking to places like beaches and parks. So a lot to consider today as we look at this rally. And I want to bring in someone to talk about that. That is Will Weatherford. He is Weatherford Capital Managing Partner. He's also former Speaker of the Florida House of Representatives. He is joining us from Tampa, Florida today. Will, thank you for joining us. And I actually want to start there, if I may. In Florida, in Tampa, in other parts of Florida, we have seen reopening in phases, although the state is not entirely reopened. And I'm just curious how you think it's been going, both from a personal and sort of a political perspective.
Yeah, well, first, thanks for having me on, Julie. It's a real honor to be on the show. I think it's going well. I mean, this has been an unforeseen black swan event that's taken the entire world by surprise, and Florida included. But when you look at the numbers, we're seeing continuous decline in the amount of cases. We're also seeing continuous decline in the amount of deaths. And so I think the Governor Ron DeSantis, has been very responsible in trying to, mitigate the impact while at the same time, letting people live their lives. We can't continue to go on the way that March and April were going. And so these are necessary opening up challenges that we'll all face, but Florida seems to be doing quite well so far.
Let me ask you real quick here, Adam Shapiro, and thank you for joining us. Both my parents are in South Florida, Dade County, which has not yet opened. But their fear, one of them lives in an assisted living facility, the other is actually working from home, is that as elderly folk in Florida, that they still may not be protected. For instance, my mom's office, despite the plans to potentially reopen in June, they're not going back. What do you say to those people who say not so fast?
Well, I think, personal responsibility has to come into play here. I mean, you have obviously very vulnerable populations here in Florida. It's an elderly population. We have a lot of nursing homes, a lot of ALFs and things of that nature. And so we have to make sure that those are protected. Even as we phase in this reopening, we cannot put our most vulnerable in a position where they could contract COVID-19. And then also companies. I think, my office, I'm here in my office, but very few people are here. There's no mandatory go back to work. In fact, we've given people the option to stay home if they want to. My guess is we'll allow people to stay home for the next several months, and most companies in Florida will do the same. So we have to use common sense. We have to find a way for people to be able to work and create value for their companies and also bring in income for their families, but we can't put more people's lives at stake. So it's a very delicate balance.
Will, Dan Roberts here. Thanks for joining us. As we look at some of the states that have begun to reopen, you're starting to see on social media the kind of unfortunate shaming that happens and is kind of inevitable. Photos, I've seen some from Florida beaches, some from Texas, all over the country, where crowds are gathering and they're not wearing masks, so they're not social distancing. And of course, it's going to be very hard to police people actually adhering to the new rules. I mean, I feel like in some ways, once you say this space is open or this is an area you're allowed to go to, there's only so much you can do to say you can now go, but you also have to keep social distancing.
And there is obviously some concern about maybe seeing a new spike in cases 2 or 3 weeks from now in some of these areas that have reopened the most. How concerned are you about that? And what can even be done as we move forward to try to really stress to people that even though you're allowed to go to certain areas now, you should still be taking X, Y, and Z precautions? I mean, people are going to behave the way they want to behave.
Well, look, we're in unknown territory here. I mean, none of us have ever experienced anything like this before. People handle it in different ways. We need to be safe. I mean, there's an expectation if you're going to go into a closed environment, people should wear masks. There's nothing wrong with wearing masks. But I also think that if you see someone who's not wearing one, you don't necessarily have to shame them and shout them down. So there's a little bit of grace here that I think everybody just needs to show to each other. Things are very partisan out there politically right now. We're going into a political season. I just think everybody needs to give each other a break. This has been hard on everyone. No one is immune. We do need to take precautions, but we also have to understand that everybody comes from different circumstances and not everyone has access to the proper equipment that maybe they would need. So again, the word I use with everyone is grace. We just all need to show each other a little bit more of it.
I don't know. I cut up an old T-shirt to make one of my masks. So I would argue everybody has that lying around somewhere. But Will, I do want to switch gears with you and talk about your business right now. You're in the private markets, and surprisingly, we haven't seen them shut down entirely during all of this. We've talked to some small companies that have managed to raise capital. So from your perspective, in private equity, are you guys seeing some opportunities here to snap up some bargains?
We do. We see a lot of opportunities. I mean, as we can tell, the markets are on fire today. There will continue to be gyrations in the public markets, but when you think about the private markets, it will take a little while for this to work itself out in the system. And so we view it very opportunistically. Obviously, there's some people whose lives have been traumatically changed throughout this process, and we feel for them. But as business owners and as investors, we do see value, and we think that valuations will come down and that opportunities to invest capital, I don't want to say a buyer's market, but maybe closer to a buyer's market than what we had just 3 or 4 months ago. Those days are coming, and we're well prepared to take advantage of it.
Hey there, Jessica Smith here in Washington, and I wanted to ask about what you think about the guidelines about reopening that we're seeing coming from the Trump administration. Do you think that there needs to be more of a hands-on approach when it comes from the CDC and the White House? They're kind of letting governors take the reins here. Do you think that would be helpful to have more guidelines, more involvement from the federal government here as states start to reopen?
Well, again, we're all going through this for the first time. I think they're doing the best they can at the CDC. Information is traveling quickly, but when you look at the United States of America, it's very different. And the challenges that we've seen in New York City are very different than the challenges you see in Northwest Florida. And so having a state-by-state approach, I think, is sound, but at the same time, the CDC has to provide the overall guidelines, which I think they're doing. And so this is not easy. We're also not China. We don't have the ability to just lock everybody down in the same uniform fashion that some other countries have. We're a free people and we enjoy that freedom. And with that freedom comes some challenges and hurdles that we have to go through. One of them is empowering the states. And really the way our Constitution is set up, it's set up to empower the states and let them make those decisions on behalf of their citizens.
Real quick, Will, when you talk about, private investment here, looking at where you might put some money, you're in Tampa, leisure, hospitality, Busch Gardens, or in Orlando, Disney, Miami and Tampa, cruise ports. Would you put any of that money into leisure hospitality right now, or would you wait?
I think I would wait. There's obviously some pain taking place in hospitality. We do own part of a marina business. It's the largest marina company in the United States called Safe Harbor. That's actually thriving quite well because people are spending more time outdoors, as you can imagine. But when it comes to resorts or places like Disney and Busch Gardens, it's going to be a slow crawl back. I think people are concerned, and even if they were to open up tomorrow, the market just isn't there yet. So I'm not a buyer in hospitality as more generally speaking, but I think that day is coming, and some of this just has to work itself out over the coming months.
Well, thank you so much for your time. Appreciate it. Will Weatherford is Weatherford Capital Managing Partner. Thanks again. Appreciate it.
Thanks, Julie.
Well, I want to move on to what's the latest on the federal response and what we can expect this week. Our Jessica Smith covers DC for us. Among other things, because of the uptick in cases in Brazil, we are seeing new restriction on travel from there.
Right, new travel restrictions on Brazil go into effect tonight at 11:59 p.m. This comes as Brazil is becoming the second, having the second most cases in the world, the country with the second most cases behind the US. So with this new restriction, non-US citizens will not be able to come into the United States if they have been in Brazil in the past 14 days. Now, this does not apply to permanent US residents or their spouses and a few other group of people, but most non-US citizens will not be able to come into the United States. The White House had originally planned to put this restriction in place on Thursday night, but then yesterday they moved that up 2 days. It's not clear why they moved that up at this point, but it will go into effect at 11:59 tonight. And then we're also watching the latest on the Paycheck Protection Program this week. Late Friday, SBA and Treasury actually released those guidelines, those rules for forgiveness that businesses have been waiting for quite some time now. They've really been looking for those rules. They didn't make the changes that many businesses were hoping to see, like giving businesses more time and flexibility in how they spend the money. But this week, Congress is considering revamping the program anyway. On Wednesday now, we do expect to vote on 2 PPP-related bills, one to change the rules to give them that time and flexibility, and then another bill that would require SBA to disclose where coronavirus relief money is going. So again, at this point, we expect that vote in the House on Wednesday.
And Jess, there's also another potential thing going on in Washington. Senate Republicans considering back-to-work bonuses. This is quite a different spin on the whole hazard pay situation. What have you been hearing on this one?
Yeah, well, Senate Republicans don't necessarily want to expand the enhanced unemployment benefits, that $600 extra that people are getting per week if they are on unemployment. So according to the Wall Street Journal, one of the ideas that they have is this back to work bonus. And one of the proposals being floated is giving workers $450 a week on top of their pay when they go back to work. So Republicans say that this would incentivize people to get back to work instead of what they say is the current situation where people are wanting to stay home because they potentially make more money on unemployment than they would by going back to work. But clearly this is going to be a debate going forward because Democrats say, you know, we need to extend that, or the Senate has proposed, Democrats in the Senate have proposed ensuring workers get 100% of their pay up to $90,000. The government would cover that cost if they go back to work. So we'll see if these two sides, these two proposals can come to some sort of a compromise as they negotiate going forward.
Yes, we will, Jess. Thank you. And I want to talk about another debate that's going on between Washington and Silicon Valley and other parts of the country. It has to do with the tweets from President Trump, which have caused controversy before, but now they are on a particular topic that's causing even more. It has to do with a former staffer of Joe Scarborough, now the MSNBC host. This is a woman who died many years ago. The president has been tweeting accusations that there was foul play. The woman's widower actually came out with a letter and said, please, President Trump, stop doing this. And Twitter, we want you to delete these tweets. Dan Roberts, I know you've been watching this situation. And a little bit of a different spin here in the request to delete the tweets instead of taking the president off the platform.
Yes, delete the tweets is the request from the woman's widower, and this woman died back in 2001. As you said, she worked for Joe Scarborough back when he was a politician. Nowadays, he co-hosts Morning Joe, obviously. And President Trump was an initial kind of, I guess, fomenter of this conspiracy. He tweeted about it as we're discussing, but it's really his son, Donald Trump Jr., who has continued the tweets and really amplified the issue to his followers. Now, the letter asked Twitter to delete the tweets in question, and then Kara Swisher, whom our colleague in tech media, wrote an opinion column at the Times about the same issue. And I think it's complicated, you know, as is always the case, and it's an unsatisfying answer. But we talk about this all the time. I mean, what responsibility do platforms like Facebook and Twitter and Instagram have to take down content that is false and misleading? And usually the cop-out, or many people think it's a cop-out, is, well, we're just a platform and people can post what they want on our platform, but we're not in the business and the habit of policing speech. That's what Facebook likes to say. And in this case, we're talking about Twitter, but that can only go so far when someone is spreading this information that is basically akin to yelling fire in a crowded theater, right? I mean, the fear and the likelihood is that these tweets from the president and from his son lead people to start looking into this, harassing the family. I mean, we've seen this happen before with Pizzagate, for example. Now, my own response and my own thing I'd say to start with is Twitter is not about to ban the president or suspend his account. I mean, that's what people always try to go to first. That's just not going to happen. Now, could Twitter delete just these 2 or 3 tweets about this woman from the president's account? Maybe. But we should say that the latest is that Twitter gave a statement on the issue that is basically a non-statement. I just want to share this before you guys chime in. We're deeply sorry about the pain these statements and the attention they are drawing are causing the family. And then Twitter says, we've been working to expand existing product features, and we hope to have changes in place shortly. That's basically a non-answer. That's, for now, we're doing nothing. And I understand people wanting immediate action.
Let me pose it this way, though, and read the letter from the husband. It's very moving. But what if this were on the flip side? If you allow those tweets to be deleted, could people say, well, why aren't you deleting the tweets about the Steele dossier, which has been proven in a lot of ways to have been false?
Exactly right, Adam. I mean, as I said, they're not about to suspend the president's account. I meant to go a step further. I don't even think that Twitter is going to delete these tweets from President Trump. Now, maybe Twitter could do something to try to get some PR points, like publicly urging the president to delete them or asking him to choose to delete them. And then Twitter gets to say, see, we did our part, and now it's in his hands. But I don't think they're about to delete them, because then you start a whole new precedent. Well, if you delete those, what about these other ones? What about this? And it's really, again, it's not easy, and I'm not letting these companies off, but I just think it's important. I think sometimes people who so vociferously say, shame on Twitter or shame on Facebook, delete this misinformation, they act as though it's a simple binary issue. It's not easy for these companies, because once you take action against free speech, then you open a whole new can of worms. So I don't expect Twitter to at least forcibly delete the tweets in question.
Right. There's also the idea that they might put some kind of disclaimer attached to the tweets, as Facebook has done with some of its posts. I want to move on to a lot of companies that are in serious financial trouble right now, so much so that some of them are filing for bankruptcy. One of them, though, that's getting a bailout, I should say, from the government is Lufthansa, the German airline. And our Tom Belger is here now to give us the details on that. So Lufthansa isn't going belly up, at least not right now, but it's getting a lot of help from the German government. Tom, you with us there? Looks like Tom might be having
it's like microphone issues there.
There he is.
Got me now.
Hear you, Tom.
This bailout's worth almost $10 billion for Europe's second biggest carrier. I think it's worth just starting by saying that it's going to be obviously a huge lifeline for their tens of thousands of workers, some of whom have seen reduced pay in recent weeks. They've been burning through more than $1 million an hour, apparently in cash. And it obviously comes naturally with strings attached in view of the issues this throws up. The negotiations have been going on for weeks about the size of the stake that the German government wants in the airline. It's the second biggest carrier in Europe. Used to be state-owned. They've settled now at 20%, with the option to make that higher if needed to stop a hostile takeover in future. The other conditions include a ban on dividends and curbs on senior pay that the shareholders and senior figures are going to have to swallow. And the final thing worth saying is it's not a done deal. You'll have to see EU approval first before this actually gets the full go-ahead. Competition chiefs there apparently weighing up cutting some of Lufthansa's airport slots in Europe in exchange for allowing this deal. That's to level the playing field, because the criticism, obviously from rivals, has been pretty vociferous. Ryanair has come out accusing Lufthansa of being addicted to state aid, saying they're going to appeal this decision. And it's quite striking too that rival IAG, which owns BA and Iberia, their shares have risen more than 20% today. That partly seems likely down to an easing of travel restrictions in Germany and Spain that we've seen. But I think also what you're seeing there is it seems to be boosting expectations that IAG itself gets a bigger bailout from either the Spanish or the British governments than it's got so far. So one to watch, certainly.
Yes, most definitely. Tom, thank you very much. I want to switch gears to a couple of companies in the travel industry that are not getting bailouts. One of them is LATAM, which is the world's largest carrier thus far that has filed for bankruptcy. It's based in Chile. It also has a Brazilian unit that is not filing for bankruptcy, although it may at some point in the future. And then, of course, there is the rental car company Hertz. And Adam, what's been interesting about all of these situations, with whether it's retailers or travel companies that have had to file, is the common theme that they were perhaps troubled already. In the case of Hertz, it had what, $19 billion worth of debt.
Yeah, well, when you talk about these reorganizations, a lot of us, I think, look at bankruptcy as the end of a company, and that's a mistake. It's a restructuring, and lots of companies have done it more than once. The airlines have been through bankruptcy reorganization periodically. But with Hertz, you point out the issue, which was going into the crisis, they were weak. And forgive me for pointing to, we talked about this last week with American Airlines. There was the rating firm that said they went into the crisis very weak, and they may be on the precipice. But in the case of American, they got a taxpayer-funded bailout, whereas Hertz isn't getting anything.
It is not. Perhaps not making the argument that it's quite as essential. Dan Roberts, you have some thoughts on Hertz as well?
Yeah, it's interesting. First of all, how this time is revealing just how many companies didn't have the financial strength to withstand a really hard 2 or 3 months. I mean, for small businesses, of course, that makes sense. It hasn't been surprising how many restaurants, sadly, are just not going to get through this because those small businesses don't typically have much cash on hand. But for a business like Hertz, clearly hurting before the pandemic came along. And then I saw that the way the company phrased it was that coronavirus dealt it a swift and sudden blow. Now, it's also interesting and kind of extra unfortunate. Again, filing for bankruptcy doesn't mean you're going out of business, but as some states start to reopen, it seems to me like, just anecdotally, the first type of travel that's going to be deemed maybe socially acceptable. And of course, there are flights and you can take flights, but road trips. I hear a lot of people saying, oh, we've been cooped up for 3 months. The first thing we're going to do is we're going to take a road trip, and you got to rent a car for that. So ironically, you might see a good time for car rental services coming up over the next couple or next few months, or even for a year or so, if some people are afraid to fly still, but they're willing to get into a heavily, nicely sanitized rental car. But tough for Hertz.
Yeah, most definitely. Well, I guess part of Hertz's problem was as well over the years, they didn't get the right mix of vehicles that people were wanting. So then people were renting from their competitors. Well, coming up next, we're going to talk about another type of company that's seeing a challenge amidst coronavirus. And it's a challenge that is compounded by climate change. We're talking about insurance companies next. You're watching On the Move on Yahoo Finance. I'm Julie Hyman. Well, our series examining the impact of climate change is continuing this week with a look at how mounting climate-related claims are forcing insurance companies to rethink their business models.
I saw the flames. I called him. I told him, don't come this way. It was on fire.
This is what's left of Becky and Lee Nelson's home.
You'd come into the dining area and the kitchen was up front here.
A dream home built over 4 decades.
Nice big closet, 8-foot by 15-foot closet.
My closet was cool. It was the best closet ever.
Now an empty plot of land.
What did this space represent to you?
40 years of hard work. It was really comfortable here.
That all changed with the Camp Fire November 2018, the worst fire in California history. Flames that tore through this community were so fierce it devoured 95% of it in a matter of hours. Paradise lost nearly 19,000 homes that day. 85 people were killed. Becky's sister was one of them.
When the chaplain came to tell me about her passing in the fire, I asked about that, and I said, when did you get the call to get her? And he said 9:30 that day. And I said, and when did you get to her? And he said Saturday, 3 days later.
All this was built up, like commercial things on both sides. There's a hotel over there.
Lawyer Joe Early says slow insurance payouts have dragged recovery here. He's helping thousands of residents file their paperwork,
So this was our front door.
even as he looks to claim his own losses, including his home.
You have to stay involved, deeply involved. You have to look at your policy, for instance. You have to read that policy and say, wait a minute, we have coverage for this, or you're not including this, you're ignoring that. How do most people do that? They've never looked at their insurance policies before. It's not easy. I mean, I'm a lawyer, and I look at that and go, what are you trying to say?
Those with insurance are considered lucky. Wildfire victims are being victimized again as insurance companies begin to drop policies of those most exposed to the fire risk.
There's no doubt that we've had a record number of filings from insurance companies who are now trying to reassess their portfolios. The fact is, over the last couple of years, there's been close to $25 billion in losses for the insurance industry. We hear stories over and over again of so many Californians investing thousands of dollars in their property, and yet they still get dropped from their insurance company.
Insured losses for global natural disasters topped $225 billion in 2018, one of the costliest years on record.
We're focusing on the 4 primary natural catastrophes.
Sean Kevlin with the Insurance Information Institute says insurance companies are scrambling to update their risk models amid soaring losses.
Loss costs have increased from the 80s over 660%. So for insurers, we've been in the business of managing risk for 300 years. So this is an increasing risk. How do we help ourselves in terms of our business and make sure we're operating our businesses right? But more so, how do we help the customer and make the customer more resilient in these increasing risks?
Those risks prompted Insurance Commissioner Lara to impose a 1-year moratorium in December, banning insurers from dropping customers. He's now partnering with the United Nations to develop a sustainable insurance roadmap for other governments to follow.
Looking at what are proper investments for insurance companies to be doing to get us to our Paris Climate Accord agreement, and also what are divestments that we want? What are underwriting guidelines? Should we be underwriting maybe coal facilities in California?
Back in Paradise, few are returning to rebuild. Its population is just 1/3 of what it was, with much of the town in limbo, just like Becky and Lee.
You planning to rebuild here?
We haven't decided. We really didn't have enough coverage to handle all that and put our house back in its original form. So it's a bit of a mountain to climb.
So really tough situation, obviously, for those folks who were affected by those fires, and challenging for the insurance companies, as you pointed out as well. Akiko Fujita is joining us now. Akiko, you talked to these folks before coronavirus, right? And so this is something on top of that the insurance industry is now grappling with.
Yeah, you're exactly right. I mean, we've been talking so much throughout our climate series about sort of this 1-2 punch that certain industries face, and the insurance industry is certainly no exception. You know, they are still in the process of assessing what the full impact on the industry will be from the coronavirus, but we've gotten some estimates on that front. Lloyd's has, for example, said they expect to pay out about $3 billion to $4.3 billion in terms of impact from the pandemic, but that really pales in comparison to the overall impact we're seeing from climate risk. The loss costs stemming from natural disasters last year alone topped $146 billion, and $60 billion of that was covered by insurance.
Akiko, those of us who've lived on the coast that are prone to hurricanes have heard for decades, why do we keep building on the coasts? And the insurance companies haven't stopped. And there have been hurricanes long before we paid attention to climate change. Do the insurance companies have any, explanation for that? Whereas with what you've just so well shown us, they are dropping out.
So, Adam, that's part of the reassessment